Hello and a very warm welcome to everyone. I am Shraja Agrawal. Any talk about markets is usually considered cheap, but when you have somebody who has experience and who has spent considerable amount of his life investing people's money into stock markets, you got to take that advice very seriously. With me is someone like that. Please help me welcome Kalpen Parekh, who is the MD and CEO of DSP Mutual Fund. Kalpen, my sheer pleasure and privilege to have you, and thank you for your time and energy to coming on the RizingTV podcast.
Thank you, and happy to be in your new version. And wish all the best.
Thank you so much, Kalpen. Whenever we have talked, it's been a very meaningful conversation. Something really tangible has always come out of it. Let's sort of really start with what is the elephant in the room. The kind of hype in the stock markets and the kind of run-up that we are seeing right now is actually making people very uneasy. You can't really be so comfortable with the kind of run-up that we have seen. Is the correction imminent? Are you waiting for the correction?
You started by saying that any talk on markets is cheap, whereas markets themselves are not cheap. On one hand, see, there's a dichotomy. There are many people who are not comfortable with market returns, such sharp, quick, fast returns in the last 2-3 years. And at the same time, there are many people who are seeking the comfort of the last 3-4 years of very good returns and assuming that this is here to stay, this is here to last, and this will continue. At any point in time, markets are nothing but a combination of buyers and sellers and diverse opinions. We are in a phase where the opinion is more positive. In 27 years that I have been in the fund industry, there has been not a single day where I have had a decisive view of either feeling comfortable or not feeling anxious. So every day there is something or the other which makes you nervous. Either higher prices make you nervous, like today, or lower prices make you nervous, like the entire phase of 2000 to 2003, 3 years of zero returns in the stock market. I remember in early days, after a very sharp 70-80% correction of tech stocks, or the period between 2008 to 13, when markets, because of the global financial crisis, fell by 60%, then within a year doubled, and for 3-4 years again went sideways. So there was anxiety at that point in time of falling markets. Today the anxiety is still there, but of rising markets. So the point I'm trying to make is, we should not be too fussed about this, feeling that all of us have. Some of us will always have a feeling of anxiety on either sides, and some people will not care about these things and just participate. So first is to embrace this, dichotomy of feeling good and bad every day. Some parts of the markets are doing well. In fact, at this point in time, more parts of the market are doing well, and few segments are not doing well. But overall, markets are heading upwards. If you ask me personally, I have over time started to learn that instead of feeling nervous, because I can't do anything about it, what can I do? I feel markets are high, so what? Markets will say, so what, it's your feeling, I'll continue to go up, or vice versa.
Yeah.
What I can do is, how do I adjust myself as an investor? Because that is all in my control. See, over time you realize that most things are futile. Most opinions are futile, including mine. Because markets have a mind of their own, world over, right? Asset classes move in different directions. So my approach is, if I am comfortable to live through fluctuations which are a part of investing, I should completely ignore anything about market levels. But as a investor, who's a very conservative investor, I many times feel that when valuations are where they are, generally in the past, if I look at data objectively, incrementally returns are closer to fixed income returns. So we are at 25 times price to earning ratio, for example, for Nifty. Our long-term averages are around 17-18 times price to earning. So if we were closer to 17-18 times, I don't have to worry much mathematically. Markets can still fall because they've gone down to 11-12 also in periods of crisis. So what I've seen is that whenever we are at current type of valuations, where many stocks are quoting at much higher valuation than what their operating metrics make them deserve, generally in the next 3 to 5 years, stock market returns at aggregate are closer to returns of fixed income. Closer, I'm saying, not necessarily lower, or so if bond markets can earn around 7 to 8% return in current interest rate regime, maybe stock markets may earn 8 to 10% returns. So the return gap is not too high, and hence I would incrementally have more bonds in the portfolio. So incrementally I will probably invest lesser in a pure equity fund and maybe invest a bit more in a multi-asset fund or a hybrid fund, which will have 30 to 60 to 70% of bonds in the portfolio, or gold in the portfolio, or global stocks in the portfolio, because global stocks in many pockets are not at a high. So I think there are ways to think about this. Yeah, I do feel that markets are high if I have to see for the next 3-4 years sort of time horizon. But sometimes yesterday, a colleague of mine was showing that in 2007 or 7th January 2008 was a market high, which the market did not cross for the next 5 years, next 5.5 years. But today when we look at that high looks as a very low point, because today we are sitting after 15 years. So the compounding of markets continues to keep rising over a cycle if you are in a good country, which thankfully we are. This comment I would not be able to make if you were in China or if you are in Japan, where compounding has not happened so much. So coming back, yeah, markets are high. They are maybe 1 year ahead of where they should be, or maybe 1.5 years ahead of where they should be. We have to embrace it versus fighting it.
I like that comment, that we have to embrace it and not necessarily fight it. So what you are saying is that we have to accept what it is.
Yes.
And instead of waiting for a correction to happen, we have to understand that how do we deal with this high,
Sure.
which basically is a portfolio allocation.
Absolutely.
You basically try to include bond in your portfolio and things like that. So I also want to understand from you, Kalpen, that there are different kind of narratives that are emerging, right? And this entire narrative about a US Fed rate cut and the thinking that this will get more money into Indian equities. But now there's also a great Wall Street Journal article which basically said the US is kind of sitting on a debt bomb which can basically explode at any time. Are we being very naive somewhere in our thinking that because of the Fed rate cut, there'll be another benign kind of environment where money will start flowing in? What are we missing in the entire equation?
So most often narratives are formed by our recent experiences in the last few years, and in the last few years, this narrative has made money that if rates are low, more money flows into emerging markets. There is a higher, demand for growth assets and stocks, and it actually helps them in their prices. And anyone who has believed in this narrative has actually been a beneficiary, and then there is a positive feedback loop. Anyone who took the opposite narrative that all of these low rates are fueling a larger, debt buildup in US, they have not made that much money. But that is also a fact. So both are truths. It's not binary, right? It is a fact that if interest rates come down globally, a lot of global capital may say that let us embrace more risk right now, and hence go far and invest in other emerging markets wherever there's logical sense. So in some sense, in phase one, some flows can come in. Till the time US is able to manage their debt bomb, which so far they've been able to manage it. How long? Who knows? And I am no expert to really think about it. It may continue till it stops continuing, and when it stops continuing, the narratives will change. So narratives will always have phases and cycles, and in that construct, many times, so we keep thinking that what could be next Fed action. There are a lot of articles and comments recently that every time there was a 50 basis point rate cut in the past, in the next year or two there is a sharp 20% correction. But actually these are random correlations. These are spurious correlations. They are not causations that because there was a rate cut there was a correction. Incidentally, in markets, every 2 years there is a 20% correction, rate cut or no rate cut.
Yeah.
So actually, when you look through some of these things, जो होना है वो होता है. So again, how do you respond to it is what you can do. Number two, like the start of this rate cut cycle is also signaling that there could be a slowdown in the world. And if the world slows down, one narrative you will hear for those who want to promote equities in India, the narrative will be India is a shining spot, more money will come, equities will do well. Other equally correct narrative would be that if the world slows down, India is not operating in isolation. 45% of our profits come from exporting to other countries. So if there is a slowdown in the world, there obviously could be challenges. If there is a slowdown in the world, China can come and dump its overcapacity in different industries, which can again hurt Indian manufacturers. So there are many divergent points at all points in time. Some will have positive impact, some will have negative, some will cancel each other, some will play dominantly. Personally, after all of these years, I've narrowed down my thinking to just saying that when there are so many narratives and some of them are really, pertinent also, you can't price them into an actionable inference. The only thing which are really useful from an actionable inference as a very long-term investor, and which is what we all are as fund managers or money managers, is that what is our job? Our job is to buy future cash flows at reasonable prices. So we have to keep looking at it, where are these future cash flows available at reasonable prices. So in India, many stocks are expensive, but banking stocks are cheap. Increase exposure there. In the rest of the world, many stocks are expensive, but few companies within that are growing still at 25% profitability and having very high ROEs, and that valuation premium is justified. Be with them, don't worry. At the same time, there are many consumer stocks globally which have corrected by 40 to 50% in the last 1 year. And so while we are at all-time highs, there are many iconic companies which have lost 40-50% of market cap because they have gone through a slowdown. Their markets are discounting bad news very quickly, unlike in India. Maybe that is an opportunity. And we start building portfolios accordingly. And as an investor, we have a choice not to put all our money today. I have a choice to do SIPs. I have a choice to do asset allocation. There are so many tools available. Just to add one dimension of why these are important, boring concepts, but important to know. You look back at history, when markets didn't make money, what type of investor made money? If you ask that question, you will get two answers. One, the one who did not, be in market, he made money because he was not in market. But then when market started making money, he lost out. So you can be one of them. You can be happy for a few years, but you'll be sad maybe later, unless you can really time very well. The second type of investor who remained in market and still didn't lose money or made enough money was also an SIP investor. 2008 to 13, market returns were zero. SIP investor made 7.5% return per annum. In the same period, an asset allocation fund investor made around 8.5-9% return, because the portfolio was a mix of gold and bonds. So when stocks fell, gold and bonds actually rose in that period. So there are different templates, and hence coming back, I feel obviously the world will at some point in time recognize that rate of growth is not as high as what markets are demanding or will be demanding. And some bit of consolidation should happen, whether in the rest of the world or in this part of our world.
Okay, so Kalpen, like you mentioned, there are too many narratives being built and there are just too many bites also coming in. So as two people, for the purpose of this conversation, one is an institutional investor sitting outside India and putting money into inequities, and second is a retail investor who is putting his or her salaried income and wealth on the Indian stock markets. How do you decipher signals in these noises? What are the three things you have to look at?
So I think, when you really cut down all the noise and narrow down and look at long history of decades of equity investing or bond investing or any asset class investing, finally what is the takeaway you get? That if companies grow profits sustainably over 10, 20, 30 years, they will make money for you in your portfolio. Companies have made between 30,000% to 200,000% returns over a 30-40 year time horizon. That is the first universal truth. So if you want to identify the big signal and not all these small noises, then that's a big signal that time will make money for you, and time in a good asset class will make money. In the same 40-year period, so there's one data which says that less than 10% companies have made these type of returns. 90% of companies in the world earn less than 5% return. So time with a good company is important. Time with a company where profits are rising steadily is important. Time with a bad company will kill you. You'll not get these type of returns. So that's the first signal, that in this long journey there are always 2 to 3 years, every second year, every fourth year and every sixth year there is a correction. Acknowledge that as the first step. And typically these corrections happen either when there is an unknown event, which anyways you and I can't predict, so don't worry about it, or when valuations are very high, generally in the next few years, a sharper correction happens. So when valuations are high, calibrate your asset allocation, calibrate where you should invest. So the big message for both these sets of investors, I would say, is respect profits and respect valuations. If you're able to do these two things, or let me say, let's invert. How do you lose money, or where do you lose money? If you want to answer that question, the answer to that will be, if you invest in bad companies, you'll lose money. And if you invest in good or bad companies but at unusual valuations or undeserving valuations, you will lose money. In the year 2000, when I started my career, most tech stocks in India were at 80, 90 and 100 price to earning multiple. Some of these companies don't exist, and some of these have become global companies, but their stocks have earned only 10-12% return. Companies grew at 40% for the next decade, but because valuations were so high. So take some of these iconic tech companies, from 100p today, they are at 25p. So over 25 years, the companies have become very large, but valuations have normalized because 100p is unsustainable. Same happened in Japan. Same happened with a lot of new age companies which came in IPOs. So keep these two things in mind to avoid losing money, avoid bad companies or companies where ROEs are not there, sustainable ROEs are not there, and avoid any company where you are overpaying. If you avoid these two big mistakes, generally you would end up earning 3 to 6% more than inflation. Is the simple truth of investing anywhere in the world. So to an investor, he has a choice. He can identify such companies in India and build a portfolio. If he's not getting enough companies like that, he can have some portfolio in bonds and gold. Or today there's an option to also invest globally and take advantage of such companies. Mutual funds offer products today where in a single fund you get all 4 asset classes, or in a single fund you can buy global stocks and Indian stocks. So for the Indian investor, that choice is available, but they are not yet exposed to that thinking because they are always thinking only binary about equity or fixed deposits. So these choices are available. For a global investor, I think the important message is that India is a very large scale market now, at $3 to $4 trillion of GDP size and market cap. It is a market which can absorb large pools of capital. India is a democratic market where, in a way, safety of capital, safety of regulations is not a worry. So you can really allocate for very long term and think of this market not as a tactical market, but as a structural long term market. It is expensive. Some of it, there are reasons to be expensive because there are very few pockets where there is growth, where there is democracy, where there is comfort of longevity of growth. It's not just size of growth, it is also the length of growth. Thirdly, typically when we look at data for global investors, most of their money is either in US as a country or it is in global equity funds, which will have 65% of US companies again and 35% goes to rest of the world. Or there will be emerging market funds, which will be again a combination of China, India, Korea, Latin America, all of that. Rarely have we seen any country beyond US having single country funds. At some stage, I think if India does not do self goals and continues to grow at its 6 to 7% growth rate, maintain profitability, India can absorb that large pools of capital. We are also seeing, not just from a stock market perspective, but even many companies are actually investing capacities in India. So they are bringing in a lot of capital. So a lot of companies are bringing in capital to set up operations in India. That has been a very long-term trend. And at some point in time, even investors will start doing it. It's not that India has not discovered. FIIs have been investing in India since 91.
Yeah.
We must acknowledge that they have been more patriotic than us.
Absolutely.
About our markets. Today there is this narrative that they are idiots. They have gone out of India and hum log intelligent hai. That is arrogance at times, I feel. So they have been investing since 91. They also make mistakes. ऐसा नहीं कि institutional investors are always best in decision making. But point I'm making is this is a very large scale market now, cannot be ignored. $1 trillion of capex every year now. It means the country can absorb capital and it gives comfort to global investors to allocate capital. So it is becoming a mainstream market. Every week, at least in the last few months, we see a lot of global investors coming into our offices wanting to know more. So while they have their concerns that markets are expensive, and we keep telling them that learn from our Indian investors where they are not maybe as intelligent as you to ask these type of questions, but they have taken the help of a simple disciplined process of dollar cost averaging. You keep coming here for last 2-3 years and keep saying market is expensive, but don't start. Versus that start with 5%. And every time, every year, like I said, there is a 15-20% correction. Take advantage of that. But to global investors, I would say that this is a very good long-term structural market. 1 year, like I said, we may be 1.5 year ahead. Maybe for 1 year, you will not make any return. Assume for 1 year, you don't make any return. But what does it mean? It means that there is a 12% profit growth rate on one hand. Our markets become cheaper by 12%, and we come to our long-term valuations. So I think growth is there. Over a 30-year period, profit growth in India has been around 13-14%. Over a 30-year period, if we take our average ROAs, they are closer to 14 to 15%, very similar to US markets. So ROE, as long as you are earning return on capital in corporate India and across a diverse range of sectors and companies, it's a great market for global investors to very seriously consider and not worry about 1 or 2 years of narratives and returns, but think from a very structural 10-20 year period. For next 20 years, where can you allocate capital and feel safe about it?
So let me ask you about that, the long-term investing approach, because you have repeatedly pointed on that as the single metric for both institutional investor and the retail investor. You also outlined that good companies.
Yes.
So what differentiates a good company and a bad company? You sound a lot like a private equity investor here, that Shrija, we are long-term investors, and use the word long-term, investing for 7 years, 8 years, but that is their business model. As somebody who's constructing a stocks portfolio for a mutual fund, I think it's a combination of both art and science. Art is intuition, that is up to you, that is the Kalpen Parekh's magic or your team's magic that is coming, it's subjective. But tell me about the science. What are the filters that you apply when you go for a stock?
Okay, so let me take it one step ahead at a conceptual level. It doesn't matter whether we are investing in a listed stock where I can enter today and in 2 minutes get out also, versus buying a private company today, and because of the nature that it is not listed, I end up being stuck for 7 or 10 years. The principles of investing will not change. Whenever I'm allocating or giving capital to a company or a stock, effectively I'm becoming an owner of that business. So you are an entrepreneur now, right? How will you keep thinking about your business? That if you have put 100 rupees of capital, let's assume you had not started this business and you had put this capital in a Government of India bond. You would have earned 8% without any effort, risk-free, sovereign bond. Over the next 10-20 years, you would earn 7 to 8% return. So if your own business does not compensate you more for the risk you are taking, for the efforts you are putting, and normally one says that if your return on your capital is 2 times of the cost of capital in the country or the other alternative safe investment, unless it is not that, it's not a great business. So that takes you to the concept of return on capital, or we use return on equity as a concept. So if ROEs are around 14 to 15% is a threshold for us. We say that if we don't like companies which are not earning a high double digit return on equity. So we have a well-defined actually investment philosophy document on our website where we've listed down the quantitative metrics. So apart from the artists bringing their judgment about trends in the industry or trends in a company or judging a management or
corporate governance,
and a lot of these things don't need only judgment. Today, if you can see through accounts, we have a forensic analyst whose job is to just see that the accounts are matching, the cash flow statement and the P&L statement are actually talking to each other and tallying. If they don't tally, whatever the management may say, there is a governance gap, and hence you don't invest in those companies then. But we have a well-documented, framework of 10 to 12 pages where we say that our preference is for companies with 16% return on equity. Our preference is for companies which over a full cycle grow their profits at least by 12 to 14%. Our preference is for companies which don't need constant capital infusion to be in business, because then it is a capital inefficient business, ROEs will come down. So we like companies which do not need debt to run. From their own cash flows, they can reinvest and run the business. Our preference is for managements which can understand, the volatility of the world in their industries and navigate and take the right decisions. So that's a very simple framework which quantitatively can help you in identifying a group of such companies. So today, when you look at any portfolio of a DSP fund, the ROE of that portfolio, aggregate ROE across all those 40-50 stocks will be 18 to 20%. So basically that is a very simple starting point, that the company or the business should be earning enough return on capital. That's the first principle. The second principle, tactically, once in a cycle, there are companies at lower ROE than our threshold, but either there is a management change or that industry is changing, going through a cycle change, and the industry is coming out of a downturn. And if we are able to get them that turning point right, or those triggers right, a company moving from 8% ROE to 14% ROE also can make a lot of money. Because when it is at 8% ROE, most people would not be owning it. Valuations will be very, very cheap. But if you get that transition, you get the profit growth as well as the valuation re-rating. And the third important dimension is, now these two are in a way very simple, and in today's world, you can go to many digital tools and screen for these type of companies. It's very easy. A layman can also do that, and which is why most of these companies are fully priced. Companies with high ROEs are also at high valuations. There is very limited free lunch available. So how do you value these companies to say that is this the fair value of the company, or is the company's fair value much lower than the market cap? So let's say the market cap is 2 lakh crores, but the fair value of the company, keeping everything in mind, is only 1.6 lakh crores. Then I'm overpaying. It may have high ROEs. It may have reasonable growth, but the market has already discounted next 10 years of growth in the price. Then I will pay for a great company, I will overpay, and for 3-4 years the stock will go nowhere. Today it's happening with banking stocks, it's happening with consumer stocks. In many cases, they all became expensive 3-4 years back. So they are going through a period of price consolidation. The businesses are still great, they are growing, but the stock has stopped growing. So these are three things that broadly you keep in mind. High ROE companies, companies shifting ROE gears, companies having profit growth in double digit, and they are available at, ideally if they are available cheap, great. But great companies available cheap is a great anomaly. It is available. These conditions happen very, very rarely. It will happen in a 2008 crisis. It will happen in a COVID crisis. But on those days, the headlines are so negative that you lose all sense of rationality. And only such investors are able to exploit these anomalies. So I think it's very simple. Whether you're doing private investing, public investing, these are some of the simple frameworks that we bring to work. And why do we say long term? Even 7 or 8 years is not long term, because the real benefit of money multiplying, our capital, our savings multiplying. We have a fund called the DSP FlexiCap Fund. It is our oldest fund. We launched in 97 at 10 rupees. Like every fund is launched at 10 rupees, right? It has grown at 18%, 19% CAGR. Very good returns in today's times. Over now 27 years. I think the NAV today would be closer to 1,000 rupees. So it's almost a 100 bagger. Now it's a 100 bagger not because of 18%. It's a 100 bagger because it is 18% over 27 years. So 27 years is the hero message, not just 18%. If you have 1 crore today and forget 18%, this fund earned 18% because in 97 equity markets were not discovered. We were closer to single digit valuations. Some of the best companies of India of today were that time at single digit valuations or close to 10-12 multiple. Today they are at 30-40. So today, unlikely we are going to make those type of returns. Most likely we'll make 10 to 12% return. 1 crore invested at 12% in 30 years becomes 30 crores. The same 1 crore at the same 12% return, if you just extend the time horizon to 75 years, assuming I want to invest for my next generation, what should the number be? So 1 in 30 years is 30 crores. So that same 1 in 75 years should be what? The answer is 4,900 crores. Wow. So that's the power of length of time, because this 30 crores in the next 7 years will become 60 crores, and in the next 14th year will become 120, and then the compounding snowball effect starts, which is why investing has to be a function of our goals. If my goal is short term, this 75-year story has no meaning, right? If I want to buy a house next year, then I have to think from a 1-year lens. Then I should not think of compounding. I should just think that my money is invested at 7-8% in a safe bond, so that 1 year from now I can take it out. Irrespective of what happens to markets, this money is safe. But if part of my goal is a better retirement, part of my goal is that, let's say today I am 50, but when I turn 75, I have enough money to beat the rising prices. So short-term goals have to be in very safe investments. Medium term goals should be in moderate risk investments, because you don't want a goal to happen on a day and then that day if we call up and say that today COVID has happened, I can't give you your money at the same value. You can't compromise on your goal, and a very long term goal should be in equity products. So fixed income, hybrid, equity, these are the three simple framework. For a retail investor, there are so many choices that it confuses you. But if you just keep this alignment of building a portfolio to your goal, not to the views of the market, because views are seasonal, they change every day. Goals are not seasonal, they are permanent.
I think the big takeaway from this conversation really is that you should perhaps hear less. I think it's safe. I think it's saner to be ignorant sometimes, because the more you hear about the market views, I think that is where the retail investor gets more confused.
Not just retail, even we as institutional investors, the more we hear, I think good investing is about stillness. There is a powerful statement I read in 2013, and this is thanks to Times of India and the courage it had to make this statement in a newspaper company publishing an interview with this headline that I'm reading out. News is to the mind what sugar is to the body. And this was an interview by one of my favorite authors who's written a book called The Art of Thinking Clearly. And he says that unfortunately our mind, it's not wrong to keep reading news or hearing interviews or taking insights. Nothing wrong, provided you don't act every day. See, we have limited money, but we have unlimited news. On limited money, how often will we keep acting with unlimited stimulus? So hear everything, but don't necessarily act. For your money management, inaction is the best behavior. Morgan Housel has made a very simple analogy to say that long-term investing is like taking a flight from Mumbai to New York, 16-hour flight. The first 5 minutes are full of action because of takeoff. You have to wear your seat belts and be safe. The last 5 minutes are a bit of action, in between some turbulence, but otherwise it's a 15-hour and 50 minutes of boring flight. That is what investing has to be. Those long stretches in between where nothing has to be done. I think if you can learn the concept of doing nothing in investing and only at extreme points doing something, and that doing something should be basis right advice, sensible advice, and counter cyclical. When the world is getting very excited about an asset class, you become less excited, and vice versa. Because natural design of a human being is to be a bad investor, including me. I'm not saying you are a bad investor or the listener is. All of us have natural instincts of being a bad investor. So we have to be the opposite of our own instincts. And I think if we gradually get that point right, we should be able to become better investors.
I think it's an extension of human behavior in various ways, right? I think a lot of behavioral insights also come into being, because boring is sexy, but how many of us like boring? We are so triggered. We are the Twitter generation, right? We're so compelled by responding quickly.
Absolutely.
So I think some of those also reflect into our investing philosophy, investing strategy, and reaction to the news and narratives. But I think one key takeaway really has been that you have to align your portfolio to your goals. And the clarity with which you pursue your goals has to be very individualistic.
It is personal.
It's extremely personal. Srija's portfolio, Kalpen's portfolio, anybody else's portfolio is up to your goals. And then I think just steer clear of all misinformation and just principle 1.1 of investing, apply that, and then pursue your personal finance journey.
Many times the challenge for me or many of us to answer questions in conversations like this, and thankfully you have not asked that question, is what is an ideal portfolio? And as you rightly said, if there are 100 crore Indians, there are 100 crore unique portfolios that would be ideal depending on your goals. It is akin to someone calling up today morning and saying, which flight should I take? There are 14,000 flights every day in the world. How do I know which flight should you take? It's a function of which city you are in. Where do you want to go? What if you don't want to go anywhere? Don't have to take any flight. So just because there is information about so many flights, or we don't call up every day morning and just call a doctor and say, आज कौन सा दवाई लेना है? So आज कहाँ पैसा लगाना है? कौन से stock में? कौन से fund में? Has to have context, and that context cannot be a general context about the market at large, because market has too many general dimensions. Even the statement that in the long term you make money in equities cannot be generalized. In US and India that has happened, but in most countries of the world it has not happened. Even over a long period of time, their equity markets have not beaten gold. because their currencies have tanked. Politically, they have been in a wrong country. So this maxim that in the long term you'll always make money has nuances, and in short conversations these nuances are never understood. So everything has level 2, level 3, level 4 nuance, and that only when you have a sense of that you can take complete opinion.
And I think my journalism professor used to say everything has to be seen in the context of time and space.
Yes.
So time and space are extremely important constraints. I also want to sort of get into this conversation a little deeper here, Kalpen. Talking about weightages in the portfolio, I mean, what really is it? Like, we have a weightage on banking stock, we have weightage on consumer stock. Do these things really matter, and whom does it matter to?
See, again, weightage is an outcome of what is it that you're looking for. So like I said, for us, when we manage money, when we manage your money or other people's money, we go back to what are the first principles. The first principles, we call it as our investment frameworks or investment philosophy documents. That is our guarding rail. That guides us to what weightage we should take. So we don't start by saying that we want to have 30% in banks and 15% in technology stocks and 12% in pharma stocks. We start by saying that amongst the 500 companies in India, how many companies are screening for the 3 conditions that we have at large, which is ROE is above 15%, profit growth about 12%, and valuations at fair value or cheaper. So out of 500 companies, it narrows down to, let's say, 100 stocks. And then in these 100 stocks, we rank that, okay, what looks more attractive and less attractive, what is at a low cycle of the business, and so on and so forth. And so in many of our portfolios today, banking stocks end up getting a weightage of 30% because they are dominant large companies, profit-making companies, but for last 4 or 5 years have underperformed, and hence their prices are cheaper than many other parts of the market. So that is the reason why they end up being 30%. In some alternate world, 3 years, 4 years later, if banking stocks have done very well and consumer stocks are cheap, maybe they will have a higher weight in the portfolio. So weightages are a function of what your ideology and belief system is. So, and it's not that our ideology is the only way of life. There can be alternate ideologies also. But all I'm trying to say is that weightage is an outcome of ideology and what your ideology is leading you to.
So how often do you churn your portfolio?
So as a fund house, our portfolio turnover varies between 15% to 40%, depending on, we have 5 different fund managers. Each fund manager has his own belief system. One fund manager says that I don't believe that I should own companies for 5, 10, 15 years because the world is changing too frequently in today's time. Disruptions are happening and markets are pricing stocks sharply up and down. So if a stock crosses my price targets, I am happy to move out tomorrow. If it busts my price target in 5 days, I'll get out, or vice versa. So that portfolio has a 40% turnover. There's another school of fund manager who says that if there's a good business, generally that business will remain good for 10 years also. And it has remained good in the last 30 years. I have no reason to doubt why in the next 10 years. So it may have price fluctuations in between. I'll take advantage of that, but I'll not get out of that company. I have very high threshold to act. So that portfolio has a 15% turnover, which means on an average, a stock stays there for 6 years. In the first example I gave, a stock on an average stays for 2.5 years. So portfolio turnovers for our funds vary from 15% to 40%. That's probably the range, and which is fine because ultimately what are we doing? Through these portfolios we are buying businesses. These businesses don't change overnight. The stock prices change minute to minute, but the businesses take the largest private bank, for example, HDFC Bank, 16% ROE. It means it takes 365 days to earn that 16%. Right now in the markets, we are earning that in 1 day, 2 days, 3 days, 5 days. So that's the concept of, they don't churn the bank every day, right? That okay, now let's sell the bank and go elsewhere. But so as investors also, we need to have our own ideology and philosophy of how to build weightages.
I think it's good that you sort of pointed about banking and stocks and long-term investing. But the counter question to that really, Kalpen, is that I'm going to use the most often used word and the most abused word, which is disruption. I think it's the most abused word in the business parlance. Can one really be safe? And is it sort of really sound to be safe, like being a long-term investor and be happy with the 15 to 20% return? Because there's just so much happening.
True. See, I think if you look at history of world's progress in the last 200 years, every 10 or 20 years, a new innovation has happened, new companies have emerged, new businesses and trends have emerged, Many companies have died. So I think destruction and disruption is natural, right? Even the human body destroys every 75 years or 80 years. So that is a very natural process. The beauty of investing and markets is that it automatically absorbs that in the index creation. So the companies which are getting destroyed with disruption become less meaningful. Their profits start slowing down. Their ROE start. So all these terminologies. That's why I say that forget the words. Convert every word that we talk of in a number. If you can quantify every metric, and you can, most generic words, when I say we like great companies, define what is greatness.
No, but Kalpen, the counter argument is that a great company for you would be a visible return of 8% to 15% ROE.
Yeah.
But if I talk to another investor who would say it's a loss-making company, but still it's a great company, Shrija, because I can see the value potential there.
So you should invest there. Nothing wrong in that. Absolutely. Yeah. And we have also at times chosen a loss-making company where we see that a big shift has happened in its business cycle, or it has sold off few businesses and a new management has come in, and the new management says we are not here to make losses.
How about the new age internet style of companies?
Great. Now in new age companies also there has to be a framework to decide that what are the odds of this company or what is the edge that this company has to win, because if you see the way most new age companies operate and the way they disrupt old companies is to start with by acquiring huge networks of customers. And in a country like India, acquisition comes at a huge cost. Indians are too price sensitive more than value sensitive. So the first round of acquisition is by throwing capital, is by burning capital. So when 100 companies do that, only one survives or two survives. As on day one, you genuinely don't know who's going to be the survivor.
But that part is being taken care about by a VC counterpart. He's taking care of that.
Agree. So we are fine with that.
Yeah.
That you give $1 billion, let them do the acquisition.
So SoftBank has done your job. Now SoftBank wants to exit.
So the first screening and the first loss taking they have taken.
Yeah.
Now let's say out of 100 companies that they funded, 10 of them are ready to come into the stock market. Now when they are coming in the stock market, an investor has tools and information today that if this company is coming in this type of an industry and there is a comparable template of that in other parts of the world, are the numbers making sense? If I assume that this company's vision and execution will play out, what is the best case scenario? What type of market share will it win from someone else? So I'm not saying you should not evaluate. We do evaluate a lot of new age companies. We've invested in some of them in a couple of our funds. We have not invested in most of them. Pricing.
So there's not comfort. There's no comfort as such.
Because either there are no comparable business models.
Or the path to profitability is not clear.
Path to profitability in our judgment or wisdom. So sometimes we are lacking. So I'm not saying we are perfect. Because a lot of things which are going to come new, there are no reference points to judge at times. But because we are managing other people's money, we have to be more careful. So in my private investing, maybe I can take that call. That I like the instinct of this entrepreneur. He seems visionary, he has all the ingredients, he has great character, he has honesty, he will navigate. Let me put my money there. I'm okay even if it drops 50%. But if I do it in a fund where your money is there, unlikely I'll be able to explain to you, because you will say on what basis you took that decision. So we have to walk that fine path. And again I'm saying that there will be few new age companies which will be much bigger than the largest companies of today. That's how Amazon became so large. That's how Alphabet became. So what I'm saying is that if we have the skill, by all means participate. But do your homework very thoroughly and take advantage of that. And the other way to participate in a lot of these great new age companies are global companies.
Yeah.
They are listed. They are available today in a tax efficient way to invest. And they are not even loss making, but they are disrupting existing companies. So today a Chinese EV maker will probably disrupt a lot of auto companies of the world, and he is available at a profitable level. I'll come and find at a profitable number. So there are opportunities across both spaces. You have to choose what is your level of competence to analyze them. Don't buy them just because they are new age. Don't ignore them just because they are new age.
Okay, my last question to you. We spoke about markets, investing, IPOs, technology stocks, behavioral insights, what really should be the deciphering signals in the environment which is filled with noise. Now I want to understand from you really, which is, how are you building DSP Mutual Fund for the future? Is it really moving with times, you think? what the significant challenges that you're encountering. Like we had someone like Chetan of Kalpen Mutual Fund on our podcast, and he spoke about really building an AI stocks powered portfolio, what they are doing. Perhaps you believe in a more Warren Buffett, Peter Lynch style of investing, where you as a human judgment picks up stocks and you have a very defined framework. But do you think that somewhere DSP Mutual Fund is anti-fragile for the future? That suppose you are not there tomorrow, how you have built this institution that when the stresses come, when the environment becomes negative, is it really anti-fragile? Will DSP Mutual Fund really flourish and emerge stronger? Has it really moved with the times, you think?
See, in the world, nothing is anti-fragile. So I don't want to make big claims. But let me also highlight that I've been a part of DSP for 7-8 years. The group is 160 years old. So it was there 153 years before me. Most likely it will be there 153 years after me or after the set of people who are working. What we try to do is to ensure that we do common things sensibly. We manage risk very well. A lot of obsession and focus is on managing risk very well. And like I said, we ask this question, tell me where will I die, so I don't go there. And if I avoid big mistakes in investing, history has shown, don't fall for fads. History has shown time and again, every 10 years, that fads is where accidents happen. Investing has to be more common sense. Now, having said that, it doesn't mean you don't evolve with time. So today, some of the big trends or challenges are, indices are, globally doing better than active fund managers. So that's something that we are very sharply focused on. So a few years back, we tweaked our compensation model for me and my entire team that we will, get our performance pay only if we are able to outperform benchmarks on a large part of our portfolio. So I don't want to outperform 5 or 6 of my peers alone. Let's say I may outperform my peers, but if all of us collectively don't beat the benchmarks, then we have not given you the outcome that you want. So one simple tweak that we have made. So see, we operate on first principles. That what is the first principle? Why are we here? What value am I adding to your money? You can go and buy DSP Nifty fund tomorrow. So if my large cap fund cannot generate more than Nifty on a 3-5 year rolling basis, then there's no need for us. So are we building our processes to achieve that outcome? Is how we focus on. Now, how do we achieve that outcome? Talent and processes, and how can technology play a role in doing these things? So we are working on extensive use of technology in every part of our organization, including fund management. But I am not in the camp today to say that AI powered portfolios will win, because abhi AI क्या हमको पता ही नहीं है. Honestly, AI has become again a very sharp buzzword. And AI will hallucinate. AI will, give you misleading content. AI may not have context. We have to train the machine. So we are working on, machine-led insights which can question even our human decisions. So we are working on an internal product. It's called ARQ, Ask Right Questions. It's a digital product, and 40% of the team working on that is a team of coders and engineers who work very closely with my traditional money managers, and the good comfort I have is that my traditional money managers,
is their insights going there,
are very humble to say that we are happy to embrace technology.
Wow.
They will not say we are forward-looking visionaries, but they are saying that yes, this is our way of life. These are good rules, good principles. Let us see how technology can learn from us and help us become better.
So there's no resistance, there's
no resistance. So they are excited to build something like this, and it's a combination of a diverse team. We have young entrants who challenge the experienced veterans. We have experienced veterans who train the young talent to even enable them to ask the right questions, and that's why we've named the product Ask Right Questions. So today, when I enter a stock and an analyst says that I want to buy this stock, these are my 5 subjective reasons. These are my objective numbers to, give a buy recommendation to the fund manager. These are the valuations. Now, if the valuations are in the higher band, the machine will ask the question that valuations are in the higher band. In the past, if you bought at higher bands, future returns are low. Why are you still insisting on this? Do your homework better. So these are simple steps we are taking. We are starting with very simple steps. Idea is to minimize natural stupidity. Automatically, intelligence will start helping us. So I think technology is a very big enabler today to do a lot of things where it can help us curb our bad human instincts. Every human being, a great fund manager will also have bad biases.
Their biases, yeah.
I will have my biases. So how, our whole idea is how can technology guide us illuminate that, okay, these are wrong biases, minimize them, and these are your good qualities, maximize them. So these are steps we take. Our product design, how do we, ultimately, why will we survive? We'll survive if we don't, make big accidents, and if we add value to our investors. If we don't add value to our investors today, in this digitally connected world, in this very well aware ecosystem, consumers have choices. There are great, this is a highly competitive industry. If there are 40 other mutual funds, there are many of them who are as competent or maybe even better than us. So investors have choices, US consumers have choices. So we are paranoid that we bring to you right products at the right time. Our culture is of doing the hard things. For example, in today's frothy market, we will launch products or themes which are in a low cycle, where the past returns are poor. So I may not get thousands of crores. I will get 50 crores, 100 crores, 200 crores. But at least the investor knows that it's in a low cycle. And when the cycle turns, I should be able to do well, versus launching a fund in a high cycle. So these are simple things that we aim to do. But the primary focus is, good integrity. If you had come to our other office, on the walls you will find honest asset management as a frame in every room. And the idea is not to just have those as words, but to actually walk the talk. If you happen to read our monthly document Netra, we very objectively communicate in that. There are 11 charts, and in 11 minutes you can finish reading that. And the whole idea is to give signals. You started by asking what are the signals and noise. It says that what are the signals today? Are the signals flashing green, red or yellow? So in some pockets they are flashing red. We will objectively say they are red. We are, almost 25% of our assets are in small and mid cap. Yet Netra says that small and mid caps are becoming frothy. This is how we are safeguarding your money in our small and mid cap funds, but these are the risks in that category. So be aware of that. I think these are few things that hopefully will help us build our competitive edge and execution edge to be ready for the future.
Thanks for that, Kalpen. Because from a distance, all fund managers look the same.
Yes.
And it's very difficult to really understand that how is one different from the other. Of course, objectively you could look at the return numbers, but only when you get to know the person, the culture behind the organization, can you really sort of pinpoint and find out how one is different from the other. And perhaps attributes are different. Perhaps for you, the attribute is honesty, conservative, long-term investors. Maybe for your peers, it could be some other attributes. So all of you are building around some attributes and some key sort of model point. Am I correct in thinking that?
No, so like I said, I've been in this, I have only been in this industry all my career, and I keep saying that, most of us come with a very common purpose, that we want to help build better financial futures for ourselves and for our investors. And उसमें attributes अलग नहीं है, उसमें एक ही attribute है कि do sensible investing and be there for long term. So everything that we can do to help you achieve that objective, I think sometimes you don't need too much of innovation in some businesses. And I think if you are able to maintain a line and length, that is all we need.
So Kalpen, how does your personal portfolio look like?
So my personal portfolio is all in mutual funds, 99%. And if I narrow it down to the underlying asset classes, around 45% will be Indian stocks, 25% would be global stocks, 20% would be bonds, and 10% would be gold and gold bonds. So it's a diversified portfolio. The approach to take this decision of this portfolio comes from my ideology that when if we are in bear markets, my portfolio will tilt towards the underperforming asset class. I like to chase past underperformance, not past high performance. So in bear markets, I like to increase risk towards equities. In bull markets, I like to increase allocation towards hybrid funds. So in bull markets like today, my portfolio has diverse asset allocation. In bear markets, it will narrow down towards equity.
Okay, now it's time for some rapid fire.
Sure.
Quickly, 5 questions. My first question to you is, if we were to do a startup in the personal finance space in the year 2024, what would that really be?
If I were to do a startup?
Yes.
I wish I had that courage to do something, because I don't have. I am happy to do what I am doing. I enjoy my work.
Give us some idea, like a reverse
pitch.
So
if there had to be a startup, I feel there's a huge opportunity in the space of making communication honest, authentic, objective and interesting. So I like to constantly think that how can we simplify our communication so that the consumer understands the principles of investing in an interesting manner, because otherwise it's too boring. Like every time I say invest for the long term is too boring. How can I convey that making a movie? How can I convey that using humor, using stand-up comedy? That's the space which excites me. The space which excites me is that how do I convey all the information of all that we speak in a data-driven manner, in a visually appealing manner, in a digital format. So, communication, marketing, personal advice delivered interestingly is a space which I think I would like to go back to. I've been reading this book called Why Do Business People Talk Like Idiots? And
did you just say that? Yeah.
And when I read that book, I realized it's talking about me. So now constantly in my mind is, okay, whatever I have said, is it now less idiot or having less idiocy? Am I saying it in a better way, in a more honest way? These are things that make me feel there's a huge space in this.
No, but I think our conversation today was pretty simplistic, I would say.
I hope so.
Okay. One startup which you really admire in the personal finance space?
So I like the work that Dhan is doing, for example, broking space. Because he's my friend, so maybe some bias. Yeah, personal finance. I think a lot of people have, like Kuvera has built a great platform for millions of people, and there are few like Kuvera. Like Kuvera is there, Grow is there. They have scaled access to investing in a very simple manner. And there are few of them. It's not just one of them that I mentioned, but there are few of them who have done a great job in giving access to investing in a simple way, giving analytics, giving data, giving portfolio visualization. So these are few companies who I really admire the way they have built. There's another partner of ours. He's in Delhi, a company called Centricity. Wealth managers who are coming out, and they've formed a startup where they are saying we want to give wealth management solutions even to retail investors, delivered digitally and delivered objectively. So today, for example, if I want to look back at my 25 years of investing and what is my IRR, simple data is not available to just see that, okay, if you had 500 transactions in your history of 25 years as an investor, in how many transactions you earned better than Nifty. And if data shows that most transactions you earned less than Nifty, stop doing this jugglery, just be Nifty. So some of these startups are solving simple but very important problems by, bringing transparency to your behavior or objectifying your behavior and making you realize that maybe your actions are not good. And hence there is an alternate way to make your investment. So there's a lot of interesting work happening in this space, leveraging technology and leveraging visualization so that investors can move away from narratives and stories, and actually data can guide them. That who are you as an investor? Are you behaving well or not behaving well?
Kalpen, what is your deepest fear?
Fear, of course, at this point in life is, I'm 51, parents are aging, so their health is always something which keeps me on my toes. My fear is, not doing well at work because, as a firm, the brand I represent is a 17-decade-old brand. So it stands for a certain level of excellence and execution. What if I fail to live up to that? That's a fear. I've been around for 8 years, but every day there is that anxiety that am I doing well? I know that there are areas where I'm not doing well. How can I do better? So that quest so I think we are all, bonded by this common theme that this is other people's money, and we want to do justice to them. Unfortunately, in money management, many products are also misbought, not missold. There's always this narrative products are missold, but products are also misbought. So how do you help people understand that, this buying decision is not right, and explain that better, else investors end up getting poor outcomes.
Can there really be something like an over financialization? Because this entire narrative of mutual funds sahi hai, put money into mutual funds. Can there be real fear like over financialization?
Actually, no, not because I am a CEO of a mutual fund and I stand for my industry, but I genuinely, like I said, mutual fund sahi hai tagline 6-7 साल पहले बना. But 98 से I've been in this industry, so I thought mutual fund सही है, 98 से मुझे सही लगता है. And I'll tell you why. It's not over financialization because see, mutual fund is not only equities. Mutual fund is not only small cap stocks or mid cap stocks. Today, in that 65 lakh crores, we are giving you access to Indian companies. We are giving you access to great global companies. We are giving you access to precious metals and commodities. We are giving you access to bonds. We are giving you access to automated hybrid portfolios, automated asset allocation portfolios. We are giving you access. You know, the concept of SIP is not there anywhere in the world, where you can start an SIP and every month money gets debited. It's nowhere in the world, in the most advanced economies. So I think it is high time that we financialize in a credible vehicle like this and set the guardrails of expectations right. The role that we have to play is the responsible communication, that what sort of return expectations you can make, and there will be volatility, there will be fluctuation, there will be periods of losses. You can't wish that away. But I still feel a long way to go, because even today there are only 4 crore investors who invested. There are 10 crore investors who are buying stocks which have no profits. I rather tell them, please come here first. At least all our portfolios, you take any portfolio of DSP or my most fiercest competitor, 18% portfolio का ROE है. We are giving you great combination of portfolios. So I feel this is a superlative platform as an industry, and more investors should take advantage of it by learning the pros and cons and then personalizing their portfolio by choosing the right strategies.
I'm sure as we do more and more podcasts, communication gets easier. But now to give me one answer, one name,
Sure.
okay? One entrepreneur which you think will go down in the history as the leader. Like there is a unicorn obsession happening in this country. Unicorns are being churned almost every month, at least in the COVID space. Perhaps the last decade belonged to someone like a Sachin or Binny Bansal, because Flipkart, it really put us on the global map. If you were to talk about post-COVID scenario, which would be that one unicorn or one that entrepreneur who stands out for you?
Outside our industry, you mean? Or?
Yeah, any outside your industry.
See, I like the way, at least I don't know him personally that well, but I like the way Nitin Kamath is building, access to finance and simplifying and, doing things in a very simple way. I'm not taking names from my group because that will be biased. I have some of my colleagues doing very interesting work. We are setting up a company called Compound Express with this whole objective of what I mentioned. If I had to do a startup, how would I, using technology, objectify data and give tools to. So one of my colleagues, she is doing some great work in that space. I won't name her right now because that'll be biased. But this is a space I think I do respect the work Zerodha has done in terms of communication, education, and providing access to millions of investors in the post-COVID world.
Thank you so much, Kalpen. Thank you so much for your time and energy for the podcast and the conversation today. And I look forward to having you more and more often.
Definitely. All the best.
Thank you, Kalpen.